Bismillahirrahmanirrahim. In the previous class, we discussed about four principles. Like one was full disclosure principle, then there was going concern principle, and then after that we discussed about revenue recognition principle. Today we are going to discuss materiality concept. According to this concept, material events are material amounts. Material means enough amounts will be recorded in the balance sheet, in the financial statements. Now, what does material means? Maybe $10 amount, it will be material for one business, but maybe for another business this amount will not be material. For a huge business, which is multi-million business, $10 is nothing. But for a small business, $10 is a big amount. This is basically material and immaterial. Now, what is materiality? Because of this basic accounting principle or guidelines, an accountant might be allowed to violate another accounting principle if an amount is insignificant. If an amount is very small, you can violate other principles. Professional judgment is needed to decide whether an amount is significant or immaterial. Now, it depends on the professional judgment of the accountant, whether the amount is material or immaterial. Now, here's an example. This thing will be much more clear to you. An example of an obviously immaterial item is the purchase of $150 printer. The company purchased a printer whose value is $150 by a highly profitable multi-million dollar company. There is a multi-million dollar company and they purchased $150 printer. Now see here. Because the printer will be used for 5 years, the life of the printer, it is 5 years. The matching principle directs the accountant to expense the cost over the 5-year period. Now, what is matching principle telling us? This is $150. So its depreciation, we can use it for 5 years. So mean the annual expense, it is $30. Suppose we purchase this printer in 2019. So $30 will be the depreciation in 2019, $30 in 2020, $30 in 21, $30 in 22, and $30 in 2023. Sorry. Matching principle is telling us that you will record this like this. $30 will be the expense in 2019, $30 in 2020, $30 in 2021, $30 in 2022, and $30 in 2023. But materiality concept is telling us something else. What is materiality telling? This is a very small amount. for this multi-million dollar company. $30 is nothing for them. So the materiality guideline allows this company to violate the matching principle. Now they can violate the matching principle and to expense the entire cost of $150 in the year it is purchased. And they are considering it as an expense because for 5 years we will make this depreciation expense. So it will make our accounting complex. So what are we doing? We are just writing $150 as an expense in 2019. And we are not distributing this expense to 5 years. We are violating the matching concept. Why? Because this amount is very small for a multi-million business. So materiality concept tells us that can you can write you can differentiate between material and immaterial amounts, and for that purpose you can violate certain principles. Like here we violate the matching concept because this $150 amount for a multi-million business is very small, so they violate the matching concept because of this amount, $150. Suppose, take another example. Salam University. They purchased, suppose, a screw, or they purchased a very small amount, and the amount is $2, two Afghanis. Now this is very small amount, and if they are recording it they are passing a journal entry for this two Afghanis amount, so it will make the accounting complex. So what are they doing? They will just leave it. They will just ignore this amount. This is called materiality, that only material amounts will be recorded in the financial statements. Immaterial amounts can be ignored. Now the next principle, it is conservatism. Now what is conservatism? According to this principle, leave this, I will come back to this. The basic accounting principle of conservatism leads accountants to anticipate or disclose losses, but it does not allow a similar action for gains. If there is possibility of loss, you will make it part of your financial statements. And if there is possibility of profit, you will wait until this thing happens. If there is possibility of loss, you will make it part of your financial statements. And if there is possibility of profit, you will ignore it. How? Take an example. We sold goods on credit, 1 lakh Afghanis. Now you know about a concept that is called bad debts. maybe out of this amount you will not receive $5,000 because some customers, they will not make payment. In this situation, now there is possibility that you will not receive $5,000. So what will you do? You will take necessary action for this, and you will write it in your financial statements. You know about a concept that is called provision. So we will pass a provision entry that maybe 5,000 Afghanis we will not receive. Take another example. Suppose there is a lawsuit in the court, and company is 100% sure that if we won the case, we will get an amount of $10 million. But the case is pending. The final decision is not taken by the court. So you will not write it as a profit, $10 million. If there is possibility of loss, you will recognize it. You will take it into account. But if there is possibility of profit, you will wait. You will ignore it until it happens. This is basically called the principle that we are talking about, conservatism. For example, potential losses from lawsuits will be reported on the financial statements or in the notes, but potential gains will not be reported. Just like I told you, there is a case in the court of law. There is possibility that you will win this case. There is 100% sure. Your liar, he is 100% sure that we will win the case. You will not record it in your balance sheet. This is possibility of profit. And there is possibility of loss. Suppose there is possibility 50% that you will win or you will lose, 50-50. So possibility of loss, it is too much. Your liar is telling you that we will lose this case. Result will come in 3 months, but you will record it in your financial statements if you are sure that you will lose the case. For profit, you will ignore it, and for loss, you will record it. This is called conservatism. Also, an accountant may write inventory down to an amount that is lower than original cost, but will not write inventory up to an amount higher than the original cost. Take another example. Suppose we purchase 1,000 mobile sets. Our business is mobile units, and the price of one unit, it is $300. Now what happened? The price of these mobiles comes down from 300 to 250. Now there is possibility of loss. The price of mobile sets comes down by $50. So there will be 50,000 possibility of loss, that there will be a loss of $50,000. Now this loss, you will record it in your income statement, because this is possibility of loss, and there is possibility of loss, so you will record it. Now what happens? Suppose take another situation, that the price of this mobile set, it goes up to $350. So now there is an anticipation of $50 profit, but you will not record it in income statement. So in simple words, if there is possibility of loss, you will record it in income statement. And if there is possibility of profit, you will not record it in income statement. This is simply called conservatism. Here he is talking about it. Also, an accountant may write inventory down to an amount then is lower than the original cost. If inventory shows lower than the original cost, you will record this loss in income statement, but will not write inventory up to an amount higher than the original cost. But if the value of the inventory goes up, you will not record it in the income statement. So here, if a situation arises where there are two acceptable alternatives for reporting an item, conservatism directs the accountant to choose the alternative that will result in less net income or less asset amount. Conservatism helps the accountant to break a tie. It does not direct accountant to be conservative. Accountants are expected to be unbiased and objective. According to this principle, accountant will take objective decision, not subjective decision. Objective decision means if there is possibility of loss, you will record it. This is objective. Subjective thinking, that the price of the inventory, it goes up, record it as a profit. No, you will not record it as a profit. Maybe after 2-3 days, maybe the price of this inventory will come down. So then again, there will be no profit. So you will take an objective decision. So in simple words, if there is possibility of profit, you will record it in the income statement. If there is possibility of loss, you will record it in the income statement. But if there is anticipation of profit, you will not record it in the income statement. This is called conservatism. So this is the end of this chapter. We are going to start the next chapter, that is financial statements analysis methods. Okay, financial statement analysis methods. Now, financial statement analysis. What is financial statement analysis? Tearing apart the financial statements and looking at the relationship. Financial statement analysis means look in detail and deep and find a relationship between the financial statements. Who analyzes financial statements? Internal users, they analyze financial statements, as well as external users, they analyze financial statements. What do internal users use it for? You know about internal users. Internal users is management. External users, our focus in this chapter will be the external users. Who are external users? Government is external user. Investor is external user. Banks, financial institutions, we call it lenders or creditors. These are the users of financial statements. Internal users, they use it for planning, evaluating, and controlling the company operations. Why management needs financial statement analysis? They need financial statement analysis for planning, for evaluating, and for controlling the operations of the company. And what do external users use it for? External users, they use it for assessing the past performance and current financial position and making predictions about the future profitability and solvency of the company, as well as evaluating the effectiveness of management. Now, two users. One is internal users inside the company is basically the management. Management, they are using financial statements for planning, for evaluating, and for controlling the affairs or the operations of the company. For simply, they use financial ratios, they use financial analysis for planning, for evaluating, and for controlling the operations of the company. External users, those who are outside, investors, lenders, government authorities, they are using these financial statements to analyze the financial performance, the financial position, solvency of the company. Why? Because investors want to invest money in the company. They will check the past performance of the company, and then on the base of that, they will take decision whether to invest money in this company or not. Lenders, they want to give money, they want to give loan to the company. So they will check the past performance and current financial position, and on the base of that, lenders will take their decision. Governments, they take the taxes. So for that purpose, they are evaluating this company. So two users, internal users and external users. And external users, they are also using these financial statements for checking the effectiveness of the management, that how effective is the management of this company. Now there are different methods of financial statement analysis: horizontal analysis, vertical analysis, common size analysis, index analysis, trend analysis, ratio analysis. You people already studied these things: ratio analysis, trend analysis, index analysis, common size analysis, vertical analysis, and horizontal analysis in fourth semester in business finance. Horizontal analysis. Horizontal analysis means using comparative financial statements to calculate dollar or percentage changes in a financial statement item from one period to the next. In one period, what is the performance? In the next period, what is the performance? And then comparing one period compared to the next period. We call it horizontal analysis. Check this. This is 1999. This is 1998. This now the balance sheet. This is a balance sheet. Now horizontal analysis example. Calculating change in dollar amounts. Dollar change current year minus base year. See, this is current year, this is base year, the previous year. So what is the change? Current year minus base year. So 12,000 minus 23,500. So here he is doing this thing. Now see account receivable. Previous year account receivable 40,000. This year 60,000. So now calculate the change. 60 minus 40. 80 minus 1 lakh. 3,000 minus 1,200. So in this way we are calculating the change. Calculating change as a percentage. So dollar change divided by base year figure multiplied by 100%. Okay, I will calculate one for you. Now check this one. $1998 and 1999. The amount of cash in 1998 and 1999. 1998, our cash was 23,500. This year, our cash is 12,000. Yes. Now, how will we calculate the change? Current year minus base year. So we will get dollar change. This delta is used for change. So current year is 12,000. Base year is 23,500. So we will get 1, 1 and 500. 11,500, but it will be negative. 12 is small, 23 is more. So there is a decrease in cash by 11,500. Now how will we calculate the percentage change? Simple. Percentage change. Current year minus base year divided by base year and multiplied by 100. This is the method of calculating the percentage change. Current year is 12,000. Base year is 23,500. Divided by 23,500 and multiplied by 100. So when you will solve it, you will get a percentage change. So here in our example, the percentage change when we calculate it, this is dollar change, 12,000 minus 23,500. This bracket is showing negative sign. And now see the percentage change, so 11,500 divided by 23,500, it is equal to 48.9. They calculate it in a different way. They use the dollar change divided by base year. So same results, because when you calculate this 12,000 minus 23,500, it will give you the dollar change divided by base year. So same thing, just use this, it will be easy for you. Current year minus base year divided by base year. So when we calculate the percentage, so this percentage is coming 48.9%. But keep in mind this 48.9% is negative because there is decrease, 48.9. There is decrease in cash by 48.9%. In a similar way, you can calculate it for all. So horizontal analysis is comparison of 2 years, 98 and 99, just like here in our example. So this is called horizontal analysis. Now let's apply the procedure to the income statement. So okay, I think for today it is enough. Inshallah, in the next class, then we will continue this horizontal analysis. Assalamu alaikum.